Let's get a sense of if inflation continues on an upward trajectory, how does that move the dial, not just for the RBI, but of course for credit markets as well?
So overall, still very positive on the credit markets. And to your point about the inflation, Rishaad, I think what is important here is not the prints that we are looking at this month or the next month, because we do expect some uptick in the inflation, not just in India, but a number of other countries on the back of reopening of the economy, as well as where the commodity and oil prices are. But question, I think, is it more transient versus is it more sustainable? And I think we will not see sustainable inflation going significantly higher from here. So overall, yes, you will see some increase in inflation, but I don't think that actually is at a point where one needs to worry about the monetary policy direction and the implication on the credit markets.
Neeraj, tell me here, though, I mean, India, alongside others, perhaps in a sweet spot because, you know, they tend to have a fairly decent fundamentals. On top of that, good returns relative to the rest of the world. So does that continue in your view?
So for the region, yes, we do see across the fixed income and the credit markets a fairly strong backdrop in terms of the fundamentals coupled with attractive valuations. The technical backdrop is in fact very positive. Asia broadly from the standpoint of credit is very underowned in global portfolios. And within that specifically, if you look at the markets like China onshore and some of the selective parts of the credit markets like China real estate, high yield investment grade credit in certain pockets, I think you have enough value and risk premia to pick up in a world which is still looking for income.
Absolutely. You know, you look at investment grade, you look at high yield here as well, Neeraj. And for you, where's the juice in this part of the world? Where are you looking?
So we like the overall credit markets here. Now, if you look at the respective differentials with the developed markets, in investment grade, you're picking up close to 60 basis points, and in high yield, 300 basis points on a relative basis compared to the U.S. markets. So the overall top-down screen's looking fairly attractive in Asia. Looking under the hood in investment grade, we like pockets in China, Indonesia, sovereign and quasi-sovereign, parts of Indian investment grade market. And in high yield, we like specifically Chinese real estate high yield, and again, selectively a number of other pockets in the region. But high yield, by virtue of what it is much more of a bottom-up security selection rather than just an overall call on the high yield market.
Neeraj, do you think there's enough preparation for a potential taper shock from the Fed, in particular when we look at, as Rish was talking about earlier, the inflation prospects creeping in?
So I think overall, I would expect the FOMC to use the word patience. And I don't think we are close to the tapering point, and hence I don't think we would expect something like a risk of a taper tantrum. Now, is the market prepared? Well, if you do get a surprise, I think the markets will actually see a shakeup on the back of it. But I don't think we're at a point where you would expect to see an immediate risk of taper. And lastly, I would argue that, in fact, in the last number of months and quarters, the Fed has been very clear that they will communicate with the market, give enough runway and time. So I think we will see that communication strategy still working out with enough room. So I don't think we are close to the taper, but if you do get a surprise in some form or shape, it will be a negative.
And you were talking there about in terms of China bonds as well. What about any potential further action from the PBOC, particularly as we continue to see, I guess, the rollout here in terms of the economy faring better, you would hope, than it certainly had been this time last year, but better than some other economies in Asia too?
Right. So I think overall something to keep an eye on, but not something that we see as a core risk in terms of any further explicit tightening from the central bank. And in fact, taking a step back, we just got some of the bits and pieces of information from the NPC. And I would say the focus has been very clear. No surprises, a balancing act, whether it's in terms of growth target, policy, or forward-looking view from a credit perspective, with a focus on a combination of quality and quantity. So a growth target above 6%, but not 6%, a fiscal deficit target of around 3.2% and not the number. And the PBOC's monetary policy stance of prudent and not tightening. So I think where you are in terms of the monetary policy cycle is going to be much more of a prudent monetary policy. One thing I would highlight is we do expect a drift lower in the total social financing and the credit growth, which means that that part of equation is not going to be as accommodative as last year. So you expect some higher increase in the default rate, dispersion, but overall no major risk from a market perspective.